Welcome back to the deep dive. Okay, so today our mission, we're diving into a whole stack of sources. We've got SEC filings, some pretty deep financial analysis, market commentary, and we're really trying to cut through the noise surrounding, well, a valuation that's just so staggering it almost bends the rules of economics. We are talking about the rumored OpenAI IPO and that colossal number, $1 trillion. So this deep dive, it's really about testing a fundamental question, isn't it? When a company is aiming for that kind of valuation, $1 trillion with basically zero history of profit, is this just, the necessary cost for the next huge tech leap? Or is it maybe the biggest speculative bubble we've seen in years?
And that's exactly why this story, well, it reaches far beyond Silicon Valley. It's not just tech circles watching this. This valuation isn't just about OpenAI's financial future. It's really a stress test for the whole AI ecosystem. And
Yeah.
maybe more importantly, it forces us, like right now, to reassess valuations across the board. And the fundamental relationship between this kind of centralized AI power and the whole decentralized world of Web3 and crypto, the capital implications there for things like decentralized compute, tokenized data, they're enormous.
Okay, right. So let's start with just the sheer, well, the audacity of it all, the ambition. The breaking story seems to confirm OpenAI just finished this massive internal restructuring of its for-profit arm specifically. That we're basically clearing the decks legally and financially to go public. And yeah, when we say go public, we're not talking about some quiet little debut. Sources are suggesting they're targeting an IPO valuation that could actually hit $1 trillion.
Which is double its current private value.
Yeah, exactly, double. To put that scale into context for you, that would vault them past Meta, past Alibaba, making it one of the biggest IPOs in history, almost overnight.
Yeah, and what's immediately fascinating, I think, is the structural tightrope they're trying to walk to get there. They converted their operational arm, the one that's really aggressive and needs capital, into a public benefit corporation, a PBC. Now, that status, it gives them the full freedom to raise capital, just like any traditional, profit-hungry company, which is what Wall Street wants to see. But they're still legally tied to the nonprofit foundation that started it all, meaning theoretically they're bound by this mission focused on safety, alignment, the long-term benefit of humanity. So that creates this immediate and I think genuine structural conflict.
Right. How do you, as a publicly traded PDC, balance that fiduciary duty to maximize shareholder profit every single quarter with a moral and maybe legal mandate to sometimes, slow down, prioritize safety over quick cash? And given the track record of other tech companies trying that, balancing mission and profit, thinking back to Google's Don't Be Evil and, well, countless others that kind of stumbled, why do analysts think OpenAI can actually pull off this structural tightrope walk?
Well, cynically perhaps, because the mission statement often ends up being more about PR than actual legal teeth when push comes to shove.
Yeah.
The PBC status looks good on paper, on the prospectus, but Wall Street is betting that when the really tough decisions come, let's say a choice between a $10 billion profit opportunity and a safety measure that costs $5 billion and delays everything, they're betting the capital imperative wins out every time. That $1 trillion valuation, it's built on the assumption of aggressive monetization, not ethical deliberation.
Okay, so that's structural tension. It only gets sharper when we actually lift the hood and look at the financials, right?
Yeah.
The engine powering this thing. Because despite all the $1 trillion hype, the reality check from the sources is, well, it's pretty brutal. The company's absolutely bleeding cash. We're talking massive operational losses. Revealed through SEC filings via Microsoft, who you got to remember is their biggest partner, owns 27%.
A huge chunk.
Yeah, and the company reportedly posted an $11.5 billion net loss just in Q3 2025 alone. Just to put that $11.5 billion in perspective for you, that's roughly $125 million lost every single day for 3 months.
Wow.
It's truly staggering.
And that immediately raises the question, okay, what exactly is $11.5 billion paying for? Because it's definitely not paying for profit margins. It's paying for the infrastructure arms race and the talent war. Simple as that. This money is just being poured into, like, two main buckets, securing massive multi-year contracts for GPU capacity, basically pre-buying the future of compute power, and holding on to the absolute best AI minds in the world through these intense bidding wars for talent. And if you look at the slightly bigger picture, their first half loss was $13.5 billion, while revenue in that same period was only $4.3 billion.
Oof.
Yeah. So even if you accept the, frankly, very optimistic projection of $20 billion revenue for the full year, That $11.5 billion loss in just one quarter, it's wildly unsustainable. Unless you have this absolutely watertight story that guarantees exponential, just unstoppable future dominance. This is the definition of betting the entire company on tomorrow.
So how on earth do you justify gunning for a $1 trillion valuation when your books are just awash in red ink like that?
You justify it with the growth narrative.
Right.
It's all about monetizing potential that isn't real yet. Unrealized potential. The core idea, the thesis, is that this insane burn rate is actually a necessary investment. It's to build the moat, to become the kind of mandatory operating system for AI agents everywhere, globally. They're forecasting explosive growth, not just from, current ChatGPT subscriptions, but from huge multi-year API deals with big companies, enterprise contracts, and eventually the rollout of these full AI agent ecosystems that could run everything from like your calendar to a global supply chain.
And the numbers they're throwing around for that growth are, well, they're audacious too. They're forecasting hitting $200 billion in annual revenue by 2030.
$200 billion.
Yeah, that's a 10x jump in revenue in just 5 years, that forecast. That's the bedrock. That's what the $1 trillion valuation stands on.
And the market, or at least parts of it, seem willing to believe it. Why? Because of the user base. Look at the metrics they have right now. 800 million weekly active users currently.
That's incredible engagement.
It's unparalleled global engagement, absolutely. But here's the catch, the monetization gap. Only 20 million of those 800 million actually pay for premium tiers right now.
A tiny fraction.
Tiny. So the IPO excitement, it's driven by pure potential. If they manage to convert just, say, 5%, maybe 10% of those 800 million free users into paying subscribers, which, the company believes they can do once these tools become truly indispensable, then that revenue curve just shifts exponentially upwards. Suddenly, $200 billion looks almost conservative. So the IPO is simply designed to get the cash now, the liquidity needed to lock in that market dominance before rivals, Google, Meta, Anthropic can catch up.
Okay, but here's where the cost of achieving that dominance becomes, well, unavoidable. The infrastructure arms race. You just can't get to that kind of scale, lock in $200 billion in revenue without spending absolutely astronomical sums on compute power. Data centers, specialized GPUs, and the prime example is that specific deal they signed. A staggering $300 billion 5-year compute partnership with Oracle.
$300 billion, just for compute.
Right. To put that number in perspective for you, it's larger than the entire GDP of several medium-sized countries. It really forces you to rethink what the word scale even means in this industry.
And we really need to connect this back to the kind of spending cycles we've seen before, particularly in the digital asset space. In crypto, the sources we looked at describe this spending as chasing energy-grade scale. It really mirrors the immense capital intensity of those early crypto cycles. Remember that?
Yeah, I do.
Think about like the Bitcoin miners building out those huge hash power networks back in the expansion phases, or how layer 1 blockchains spent massively on infrastructure grants, security, all to secure future network use. OpenAI is basically doing the same kind of giant anticipatory bet. They're spending unbelievable money now at a record pace, hoping to secure that future market dominance later.
That comparison to Bitcoin mining is interesting. It's compelling because both are super capital intensive, yeah. But is it really an apples-to-apples comparison for investors? Bitcoin's utility, its value, it's secured by math, right? Like cryptography, verifiable hash power. This AI dominance, it seems to rely more on proprietary data, holding on to talent, keeping a software lead. Is that difference in risk like hard infrastructure versus maybe softer intellectual property being properly factored into that trillion-dollar valuation?
That's a really critical distinction.
Yeah.
In crypto, your capital spending directly secures the network itself. Hash rate, TVL, whatever. It's more direct. In AI, the spending secures the potential for future market share. So the risk profile is definitely higher because the moat relies on these, as you said, softer factors, talent, proprietary data, things that can be challenged, maybe poached. That $300 billion deal with Oracle, it isn't just buying hardware. It's like a non-refundable ticket to enter this incredibly expensive race, where maybe the runner-up gets almost nothing. The sheer scale of the spending, though, it signals to the market and maybe more importantly to their competitors that they are absolutely playing a winner-take-all game here.
And this level of spending, this valuation, it leads us straight into market psychology, doesn't it?
Yeah.
Investors generally seem to see OpenAI as the undisputed flagship for the whole AI revolution, kind of like how Bitcoin served as the main flagship for the blockchain space for a long time.
The bellwether, yeah.
But, as we know from crypto and elsewhere, flagship assets attract immense excitement, and sometimes, well, they fly a bit too close to the sun. And our sources actually highlighted a very recent warning sign from another tech giant. It shows just how volatile the market's tolerance for this kind of AI spending really is. Meta recently announced they'd be spending $72 billion on AI this year alone. $72 billion. And their stock promptly plunged 11% the next day, wiped out $200 billion in value overnight.
Ouch.
Yeah, that was an instant market reaction driven purely by the fear of just massive non-revenue generating spending in AI.
And this is precisely why the success or failure of this OpenAI IPO is going to have these profound ripple effects, contagion effects. Across that whole AI crypto convergence space we mentioned earlier, we're talking decentralized compute networks, tokenized data markets, AI agent ecosystems being built on Web3 infrastructure. Look, if the IPO succeeds, if they actually raise the capital at or near that $1 trillion valuation, it acts as this massive legitimizing force. It basically confirms AI as an unstoppable multi-trillion-dollar megatrend in the eyes of big capital. And money will flood out of traditional tech right into those blockchain AI hybrids. Projects like, say, Fetch.ai doing decentralized agents, Render focusing on decentralized GPUs, Singularity Net. It gives that whole decentralized AI sector a huge credibility boost. And a capital boost, however, if the IPO underperforms, if the market looks at that $11.5 billion quarterly loss and just says, nope, $1 trillion is too much hype.
Which is definitely possible.
Absolutely possible. Then it could trigger an immediate sector-wide AI valuation correction. And that correction will absolutely spill over into the crypto narratives tied to decentralized compute, AI tokens, all of it. This IPO really will be the ultimate bellwether, telling us where the market thinks the heavy spending stops and the actual profit needs to start.
Wow. Okay, this deep dive into the numbers, the structure, the market psychology, it's been incredibly illuminating. And hey, before we wrap up, if you're finding this kind of breakdown valuable and you want to keep getting these deep dives on the biggest shifts in tech and crypto, the stuff that really shows you where capital is flowing, well, subscribing, commenting, engaging with our content, it really does help support the channel a lot. It boosts our visibility in the algorithms, lets us keep making this kind of content for you. So thanks for considering that.
Yeah, definitely. And ultimately, the core tension here, it remains exactly where we started, doesn't it? This IPO is going to test whether global markets, maybe for the first time in a decade, truly value alignment and safety, the public benefit core mission, or whether at the end of the day, they just want short-term growth and hype. Regardless of the ethical questions or, frankly, the financial burn rate, it's really a test. Is the future of tech going to be driven by capital first or by mission first?
So here's the final thought for you to reflect on. Consider that incredible contradiction we just laid out, an $11.5 billion net loss in a single quarter.
Yeah.
Yet the push is for a $1 trillion valuation based on hitting $200 billion in revenue 5 years from now. Can AI profits ever truly catch up to the sheer scale of the AI hype? That's the billion-dollar question. Or perhaps, the trillion-dollar question you need to keep mulling over as you watch this absolutely monumental story unfold. Thanks for joining us for the deep dive. We'll catch you next time.